So yesterday, Jamie Dimon, who has been the CEO, the person who runs pretty much the biggest bank in the world, JP Morgan, for 2 decades now, he came out and he spoke to his investors talking about what he thinks is going on in the markets and how JP Morgan is positioning itself to ensure that no matter what happens, they come out on top. Now, there's been a fair amount of news about this topic and this event because actually Jamie Dimon came out and used one word which has really instilled fear in an awful lot of people. In short, he said that a hurricane is coming for the American economy and that no one knows what's going to happen next, but his gut tells him it's pretty bad. Now, if you're like me, you probably weren't satisfied with just watching that 20 or 30-second clip that seems to be going around everywhere, so you probably spent some time trying to find the full hour-long interview. And unfortunately, you probably couldn't find it because I couldn't find it either. In fact, I spent about 2 hours today scouring the web trying to find access to this full interview, but I just couldn't. And it turned out the reason I couldn't find it and the reason you probably haven't seen anything longer than that 30-second clip where Jamie Dimon says the word hurricane is because actually JP Morgan are trying to keep this interview on the down low. To get access to this, I basically had to cosplay as a real financial journalist, give over details of my company, my role within my company, my name, my address, and everything like that, just to get to even watch this video. I thought then it might be a little bit useful to show you some more context into what he was saying, why he thinks there's a hurricane coming, and everything in between. So firstly, I'm going to show you a clip that you probably, actually almost definitely haven't seen so far about the 3 horsemen of this next apocalypse that Jamie Dimon is predicting.
And you mentioned storm clouds.
Yeah, I'm going to change the storm clouds because I said there are 3 things that we're going through, which are, I hate the word unprecedented, which are kind of unprecedented. And you got to put this in back of your mind when you've seen things that have never happened before, then you have to question your ability to predict. Okay, one is huge growth in this country driven by fiscal and monetary stimulation. That isn't a normal recovery. Okay, and that fiscal stimulation is still in the pocketbooks of consumers. They're spending it at very strong levels. And the data is completely distorted. It's distorted by inflation. It's distorted by they went from goods back to services. It's distorted by all these things. But jobs are plentiful. Wages are going up. Consumers are spending. The lower income folks not quite as much as before, but everybody else, it looks like they have $2 trillion more. Savings rate drop. I don't think that's going to stop their spending in 6 or 9 months. So that to me is the bright clouds out there. But it's different. The Fed has to meet this now with raising rates and QT. And the new part of this isn't the raising rates, it's the QT. The QT we've never had QE before like this. Therefore, we've never had QT like this. So you're looking at something they're going to be writing history books on for 50 years. What was QE? What worked? What didn't work? I think a lot of parts of QE backfired. I think the negative rates was probably a huge mistake for a whole bunch of different reasons I won't bore you with now. But they have to raise rates, and in my view, they have to do QT. They do not have a choice because there's so much liquidity in the system. They have to remove some of the liquidity to stop the speculation, to reduce home prices, stuff like that. And you've never been through QT. So all the major buyers, if you go back to 2010 and say, who are all the major buyers of treasuries? All that time, it was central banks, foreign exchange managers, banks who were topping up their liquidity profiles because we had to for regulations. All 3, it won't happen the go round. Banks are topped up, foreign exchange managers are topped up, the central bank will be selling, not buying, and governments have much more fiscal deficit to finance. That's a huge change in the flow of funds around the world. I don't know what the effect of that is. I'm prepared for, I tell you, a minimum huge volatility. And the third thing is Ukraine. That you've not had a European land war since 1945, okay? And the complexity of Ukraine is we don't know the outcome. I always make a list, if you predict the outcome. Well, you couldn't predict the outcome of Vietnam, Korea, Afghanistan, Iraq, 10 other conflagrations. All wrong. Wars go bad. They go south, they have unintended consequences, and this happens to be rolling the commodity markets of the world. Wheat, oil, gas, and stuff like that, which in my view will continue. We're not taking the proper actions to protect Europe from what's going to happen in oil in the short run, and we're not taking the proper actions to protect you all what's going to happen to oil in the next 5 years, which means it almost has to go up the price. We're not investing enough money to keep oil a number. And for all those who love climate change, if oil prices go to 175 or 150, which I kind of think is in the cards, to tell you the truth, not in the immediate run, but down the road, then CO2 won't go down, which is everyone predicts because people buy less oil and gas. It's going to go up because all those other countries out there, the poor countries who need oil and gas to feed and heat their citizens, will not buy oil and gas, they'll buy coal. That's what's going to happen. CO2 will go up, it won't come down. And we're not dealing with these challenges. So those three things, fiscally induced growth, QT, Ukraine war.
So the first major issue that Jamie Dimon is really worried about is this unprecedented level of growth that we've seen, not just over the last 2 years, but actually over the last decade and a half. And the reason he's worried by it is because it isn't natural growth. It isn't coming about from entrepreneurs building brand new innovative businesses. It isn't coming about from people spending more of their disposable income or earning more money. It's come about from gross monetary policy, from a government and a central bank that is just printing money willy-nilly. Basically, he's worried because this level of growth that we've seen that fueled this massive bull run over the last decade and a half came from quantitative easing. Now, the other problem with quantitative easing is that actually it is still rather unprecedented. It has happened twice in human history. The first time was with Japan over the last couple of decades in an attempt to revitalize their struggling economy, and in short, it didn't really work out. The other time we've seen quantitative easing, the only other time in history it's ever occurred, has been over the last 15 years in the post-housing market crash era. Now, the problem with that is that this era of quantitative easing hasn't stopped. We never got to the other side. In reality, the money printer was turned on back in 2008 and it hasn't been switched off since. And so when it does get turned off, no one really knows what's going to happen because there is no precedent. Now, the second major headwind facing our economies, according to Jamie Dimon, is the fact that actually the Federal Reserve doesn't have a choice and it has to end quantitative easing now, and it has to start the next major problem, quantitative tightening, which has literally never been seen before in human history. It is entirely unprecedented. As a result of that, there is no evidence to look at. There is no history. You cannot look back to see what happened in the past and try to use that to gauge what will happen in the future. All we can do is try to model what we think is going to happen and pray that we don't miss something major. Now, Dimon also came out and said that actually it's essential that quantitative tightening happens because there's just so much excess liquidity in the markets and it is fueling rampant speculation that is causing this ridiculous level of inflation that we've seen grow over the last year. And in particular, one thing that he did say, and he only mentioned it for a few seconds and most people probably glossed over it, he said that actually quantitative tightening has to happen to cause house prices to fall. Now, on the surface, that's a good thing. Lower housing prices means more people have access to the market. But the problem is that most people have debt on their house and most people use their house as a sort of retirement and investment fund in and of itself. So when prices fall, I'm afraid it isn't as simple as just new people can enter the market and all is good and happy. Now, finally, the third horseman of Jamie Dimon's apocalypse is, of course, the Ukraine war, the first major land war in Europe since 1945. And as a result of that, we don't know how much this is going to impact markets, and we've already seen it have quite a major toll. Dimon also makes the astute observation that actually we can't even really predict how this conflict is going to play out. Before it started, everyone in the world thought that Ukraine was the underdog, that they had pretty much no chance, and that really this would last a week or two, if it even happened at all. Now we're 4 months in and we couldn't have been more wrong. It isn't unreasonable to assume that in 4 months' time right now, what everyone's predicting is going to be wrong as well. Now, because we don't know who's going to win or when this war is going to end or what it might look like once it ends, we can't possibly know how commodity prices are going to be affected by the war either. We do know, though, that commodity prices have already seen massive inflation due to this war, and it isn't too unreasonable to assume that as the war progresses, this price inflation is going to maintain, and that's something that actually Jamie Dimon is fully expecting, him even pointing out that maybe oil prices of $180 a barrel, a all-time high in human history, isn't even unlikely at this point. Now, while that stuff there isn't exactly good news, it's certainly not bullish, and I would wholeheartedly describe Jamie Dimon as bearish for the majority of this interview, well, this next bit is the bit you've probably heard about. the one where he literally says there's a hurricane coming for the American economy.
Look, I'm an optimist. You know, I said there's storm clouds, they're big storm clouds. It's a hurricane. Right now it's kind of sunny, things are doing fine. You know, everyone thinks the Fed can handle this. That hurricane is right out there down the road coming our way. We just don't know if it's a minor one or Superstorm Sandy or Sandy or Andrew or something like that. And you better brace yourself. So JP Morgan is bracing ourselves, and we're going to be very conservative in our balance sheet on, with all this capital uncertainty. We're going to have to take actions, and I kind of want to shed non-operating deposits again, which we can do in size, to protect ourselves so we can serve clients in bad times. And so that's the environment we're dealing with. And I think it's okay to hope that'll end up okay. I hope it. That's my Goldilocks. I hope. Who the hell knows?
So it should be abundantly clear at this point that Jamie Dimon, one of the most successful and powerful men in finance the world has ever seen, the man who built JP Morgan up to be the mega institution that it is today, is worried for what's to come. As a result of that, he is preparing JP Morgan for what's to come as well, ensuring that it is able to weather any kind of storm. And frankly, it would be prudent to follow his advice, to move in the same direction, to make sure that we're in the same sort of position, that we're not over leveraged, that we're not held down by excessive spending that isn't necessary, paying out thousands of dollars more than we can afford for cars that we can't afford or homes that we don't need. As always, this isn't financial advice. It never is on YouTube. It can't possibly be, because you're just a person behind a screen and I know nothing about your personal situation. But I do implore people to just be cautious, to be a little bit conservative, and be aware that really we are in unprecedented times, that you can't look to the past to gauge what's going to happen in the future, because we've never had anything like this happen before. If you enjoyed this video, then make sure to like, comment, and subscribe to bless the YouTube algorithm. It really does help. If you want to join our exclusive community, then check out our Patreon. You get access to our Discord server and extra content like access to my portfolio and buy and sell alerts for all my own investments. Also, make sure to check out the link in the description to Masterworks. They can help you protect your portfolio against market turmoil through fractional shares of art from world famous artists. Art has historically proven to be uncorrelated to the markets, so it's a really valuable resource with the markets falling every week. There's also a link in the description to iTrustCapital, a site that allows you to invest in crypto through your tax-advantaged IRA, which could literally save you thousands. If you think that crypto going down is a buy-in opportunity, then now is the perfect time to join iTrustCapital. Thank you all for watching. Stay stoic. Until next time.